Hey everybody, welcome back to Matt Money. Today we're going to be walking through how to start investing with $1. And now I think a lot of you guys might get triggered by this video because you're probably expecting some real quick way to be able to invest $1, to be able to get to $1 million, $2 million, $10 million. But the real truth of the matter is it takes time, it takes consistency, and it takes a lot of effort in order to make sure that your investments pan out appropriately. Some folks can get really lucky in the market, and I'm sure you've heard stories about a guy turning 50,000 into $2 million, or vice versa, invested in Bitcoin. I mean, you have to think, yes, there are going to be a lot of those cases where people can get lucky, but I'd say for the vast majority of us, we need to act within what makes us feel comfortable in order for us to return in our investments and gain our wealth throughout the long term. And so what I've kind of recognized over the past 6, 7 years of investing since about 2012, so maybe a little bit longer now, is really the mistakes that I've learned that have kind of shaped into a 5-piece strategy that I kind of use before I kind of have people start investing. A lot of people over the past couple weeks have been like, what do I do? What do I do here? Should I do this? Should I do that? And I think what ends up happening is a lot of people just kind of go in blind. And when you have investments that don't really have any sort of strategy, you start to blend strategies together. You saw this person doing that, you saw this person doing that, and that's fine, but it might not necessarily align perfectly for what your investing strategy or plan would be. And so when that person might be exiting that position, they might not necessarily tell you, and they might walk away with a 40-50% gain, and then the next day it goes down 20-30%, and you walk away with only being up 10%, or even down potentially, just based on the fact that some of the positions that they might be investing in are extremely volatile. And so what I have for you guys, and I also have a blog post for you guys which I'll kind of highlight as well down in the description below, is basically the 5 key things. So obviously the first thing is what's your objective? For me, I'll just highlight personally, mine's to basically get enough cash flow where I can basically be financially independent over the next 5 to 6 years. So that's kind of my aim, and I've been investing on a month-to-month basis to be able to try to increase my cash flow on a year-to-year basis. Currently, you can see how I track my spreadsheets and the effort that I have been putting in to make sure that I get to the points and the objectives that I want to. You can see at the moment I'm looking at about almost $14,500 in the next year in terms of dividend income, and I'm by far no means close to being done. I need to expand this by another 2 to 3 times before I even feel that I can be quote unquote financially independent and really get it to the place where I want it to be. And that will continue to be happening over the next couple years. And then 2, and I have a bunch of graphics within here as well. 2 is basically what's your risk tolerance, and I think a lot of people can really relate to this pretty heavily. Over the past couple weeks, we've had a lot of volatility due to the recent pandemic that's kind of been going on, and so you can see just basically the S&P 500 fund, or I'm using IVV, which is iShares Core S&P 500 fund. You saw this peak to trough go down 40%. 35 to 40% within a month's time period. Now, a lot of you people might say that that's relatively extreme, but I mean, that's not necessarily out of the realm in the terms of history when you're dealing with investing in the stock market. And I would just take a moment to reflect upon yourself am I okay with having a peak to trough loss of 40% within 2 to 3 weeks, which is kind of what we saw here in the beginning of February to the middle of Marchish time frame, 3 weeks time period where the market declined 35 to 40%. Now it has since kind of come back up. But in the meantime, I've heard of stories where people say, oh my God, they freaked out. There's one gentleman that I talked to the other day, was up about 40 to 60%. In his mutual funds, it got down towards this bottom and he sold. Now he's sitting in mostly cash. He does have some still invested, but I'd say over 50% of his portfolio is still in cash. And so what ended up happening was he sold and lost and basically ended up with the principal that he ended up with and had in the before. But now he's looking to buy back in when he's lost 20%. That's an example of someone that hasn't set their portfolio up or set their mindset or strategy up for investing with specific risk tolerances. he knows or she knows that potentially investing in this market could be a very volatile game where they could lose 20, 40, 30% uh, within a certain amount of time period. And if you look at this broader spectrum, had he just held on straight, and as long as he believes in the economy of the US, uh, it could eventually come back to be beneficial in the long term. Even in 2008 time period, it took until mid 2012, 2013 to get back to where we were in 2008. And ever since then, we've almost doubled from where we were in the all-time highs. In fact, we've way doubled from where we were back in 2008. So you're just consistent, and you're keeping in mind the risk tolerance. You won't make rash decisions and get emotional when these sorts of decisions kind of happen. You can see that, okay, it's one thing if one particular company does this or is going through a struggle, then it might be time to cut losses. But if it's a macroeconomic problem, it's something that you might want to reconsider. And that kind of brings me into the third thing with this, and this doesn't necessarily have an order of importance. I do believe that some of these are probably polishing, and some of these are hugely foundational. Your objective and risk tolerance being extremely foundational with what you need to know in order before you uh, really dive deep into things. But what I really want you to consider is how often are you going to be contributing to this portfolio. Now, and what your time horizon is as well. So those are the two things also that I want to kind of bring up. One, your time horizon, and then two, how much additional capital. And we'll kind of dive deeper into the additional capital in just a moment. But if you look at specifically time horizon, I want to show you guys a very important kind of metric, or at least a quick exercise that you guys can do. Let's just say you want to get to the point where you have $250,000 as your objective. One person says they want it to be 5 years away. Another person has 20 years away as their kind of time horizon. And what I want to show is the addition of $5,000 of capital, which we'll kind of touch on this a little bit more on the next tab and the next example we have here. But let's just say every single year they add an additional 5,000 and they start off with 5,000. So both cases, 5 years and 20-year time horizon, start off with $5,000 in the longer term here. And basically when you're going through, we're just kind of looking at what type of returns you would need to achieve in order to get to this $250,000 in the allotted time horizon. So for 5 years away, you need to get to $250,000 in 5 years, and for 20 years, you need to get to it in 20 years, right? That's pretty self-explanatory, $250,000 in 20 years. Your return, or the rate of return that you would need to achieve in order to achieve this, is rather reasonable for the 20-year time horizon. You're putting in a total of a decent amount of cash, probably up to $100,000, maybe $105,000 over time, and you're returning that at about 7-8% over that time period. It's going to lead you to double your money and then some over the coming years. So that also being said, if you were to shorten that time horizon by 75% and need that money in, say, 5 years, you're going to have to invest completely different. The 7.9% return is something that is relatively easily achieved by investing in something as simple as the S&P 500 total stock market fund. Something along those lines where it's not necessarily going too extravagant in terms of rate of return, but it's also not too conservative. You might have some up years, you might have some down years. Something like investing to get $250,000 in 5 years with your initial starting capital and only $5,000 of additional capital contributions, you're going to need an 89% return. So you're going to have to invest in a completely different way in order to be able to achieve whatever goals you sort of have. Now, of course, this is basically just saying to yourself, I mean, if you're saying you need $250,000 in 5 years, just stomach the reality that you need to basically get an 89% return in order to get there. And you're going to have to invest aggressively, very aggressively, high risk in order to get to that point. Whereas in this 20-year case, you could take a little bit more conservative approach. You have a lot longer of a time horizon to rather ride out some of these ups and lows. And it gets exacerbated by the fact that maybe you might have an inflated idea of what your objective is, and you might need to necessarily change that or be more realistic with your target. If you're starting off with $5,000 and you also are contributing zero, which we'll touch a little bit more, you're going to almost half the amount of money that you're getting. It's only 120,000 now, considering you're still investing at an 89% return. So you might have to change the total amount that you're kind of increasing and expecting to get in the long term. And this is another thing that I kind of want to touch on here. Just a quick example. I kind of briefly showed you this. This is kind of irrelevant now, so let me erase that. Actually, I need it, but let's erase the names here because that's not really important anymore. What this is basically showing you is both are 8% returns year over year, so very similar to the case we kind of just looked at here, where you're getting a 250% return in about 20 years. Now, keep in mind, with that previous example, we were investing $5,000, right? And in this particular column here, in column F, we're not adding any additional capital. So this is the 8% return every single year. And you can see that it goes from being a 20-year time horizon to over 50 years for you to get the same objective. And what I basically want to add onto this is, now we've kind of touched on your objective. We've touched on what your risk tolerance is. We touched on your time horizon and how important that is. Now, the fourth thing that I really want to touch on is how actively you're going to be contributing to this portfolio and how important that may be to be able to achieve your objectives. If you're able to contribute even just $25 a month comparatively to, let's just say, the additional $100, or not, maybe not $25 a month, but $100 a year. Let's just do $1,000 a year, or $1,200 a year, which is $100 a month. Just look at how much additional money you have in 20 years. It's almost $56,000 of additional money that you're actually having in the portfolio just by contributing another $100 a month. That's just something that can go to show you how extreme just adding a small amount of capital and feeding this nest egg can really be in the long term. Now, of course, some of the numbers kind of break down because I have them kind of set up specifically for this example, but it just goes to show you, how massively important continuous capital contributions are and can be to the portfolio, because it's basically like adding another starting portfolio that goes out another 20 years. It just only has 19 years, and then the year after it's another 5,000 that has a chance to grow 8% a year, but starting at 18 years away. So extremely important for continuous capital contributions to the portfolio to be able to achieve goals and at least shorten the amount of time you might need, and at least gives you kind of a buffer as to how much you might be able to achieve. I mean, just think about it. If you're investing $1,000 initially, and you want to get to $1 million, you invest another $1,000 a month later, or let's say a year later, you now have to have the amount of times you need to double your money in order to achieve that $1 million goal. You might have needed to, get 1,000% return over the course of the next 20, 30 years. But if you add another $1,000, you have that immediately, because now you had to go from, instead of 1,000 to 2,000, which is 100% return, you now just have to go from 2,000 to $1 million, which basically halves the amount of work that you now need to do and the amount of return that you need to look for. So being a crucial saver and just making sure that you're investing appropriately throughout time and investing a decent amount of your portfolio and income from your percentage of your income into the portfolio will just accelerate the amount of money that you have in the portfolio in the long term. One of the examples I also want to bring up, and this is probably the one that hits home the most, I think a lot of people want to immediately invest into individual stock positions, and there's nothing wrong with that. But I think what a lot of people don't recognize is the amount of time that it may take to invest their time into investing into individual stock positions. There's absolutely nothing wrong with investing in ETFs. In fact, I think that most people in the world should be investing in ETFs. It's rather passive compared to the active investing that you might need to do. And what I mean by how active you want to be or passive you want to be, I mean very considerate of your time, not time horizon, but the time that you have to dedicate to this craft. And basically what I wanted to say earlier was basically if you don't really have the time of day to be putting into looking into individual stocks, that's fine. And I'm not poking fun at you. I know I personally put a lot of time and effort into the stock positions that I hold in my portfolio, and as well as just making sure that they're doing what the company has promised. And me being a shareholder of the organization, I agree with what's going on. But if you don't have the time, just acknowledge it. I mean, I think it's more mature to have in your plan to acknowledge whether or not you have the appropriate amount of time to put in. And what I think was at least a minimum amount of time that you need to put in every single quarter is at least an hour for each individual position that you have. What you need to look at is the financials that are coming in, looking at specifically what each of these metrics kind of are. Did the company's earnings per share kind of raise compared to last year? Has the price to earnings ratio changed compared to last year? Is the company on target for what they're looking like compared to the market cap? Looking specifically at the financials, looking at the balance sheet, looking at the income statement, looking at the cash flow statement. Is the company making the right decisions at the right time and doing what they said they would? I don't necessarily go down into specifically breaking down balance sheets and how to read that. In fact, one of my buddies did this, Kyle from Passive Income Investor. He has a course that he basically just has out here under Stock Market Education. We'll have the link down in the description below. Relatively quick and easy. He breaks through it. It's about 45 minutes, maybe even closer to an hour. I forget. But phenomenal course. I looked at it. I personally used it, and I brushed up on a couple things that I wasn't familiar with. But, I mean, keep in mind, this is just one company that you need to keep a track of. Do you want to do this for 20 companies, 30 companies, 40 companies? Then you start recognizing that that's 20 hours, 30 hours, 40 hours every single quarter. So you multiply that by 4 quarters, you're going to be starting to talk about 160 hours potentially, anywhere between 80 to 160 hours, depending on the number of positions you have, that you need to concentrate. And keep in mind, 2,000 hours is a full-time job. So when you have 40 positions, you're talking about almost a tenth of a full-time job, which ends up being close to an hour a day, maybe even more, of actual physical time looking at some of these sheets, and making sure that you have the time to upkeep. And another aspect of things is if you want to day trade or swing trade, you're going to have to put a lot more time in it than that. I mean, you want to be doing day trading, you're going to have to be looking at this 1 to 2 hours every single day. You might have a lot less positions that you might be looking at. But that being said, I think I think you need to be investing at least an hour or 2 hours at least at a minimum every single day. You want to be day trading. You want to do swing trading, you might have to be putting in a couple hours every single week, but it won't be nearly as severe than if you were trying to day trade, the amount of time commitment. And so I think you just need to recognize those things that will help kind of shape your investment strategy to help understand what kind of investor you want to be. If you don't have the time, then being a buy and hold investor is probably most likely what you need to do. If you have a lot more time on your hands, unfortunately, maybe you got furloughed, or maybe unfortunately you're sitting with unemployment on your hands. Maybe it's an opportunity for you to put a little bit more time into day trading, but there's a lot more intricacies between each one of these strategies that you need to consider. If you're going to be a day trader, you're going to be looking more on technical analysis rather than fundamental analysis. Swing trading, it might be a combination of both. So I think that you just need to be understanding of it can't just be something where you dive both feet in and immediately become successful. Of course, if you guys are interested on passiveincomeeducator.com, we have a blog aspect of the website as well. And I basically wrote a decent little article that kind of highlights a little bit more into what you're kind of we're talking about in this video particularly, and a couple examples as well if you're curious and trying to understand how you invest and setting up a specific strategy. So one of these examples, it says that somebody's looking at a 3% portfolio versus a 5% portfolio in order to generate the amount of income, and we kind of go into how much money somebody might need in order to do that. But yeah, I think that that's all very important, and I think that you just need to recognize what your time horizon is. If you need a day, if you need the money in a year, you're going to make completely different decisions than if you need the money in 10, 20, 30 years. If your risk tolerance is, I don't want to lose any more than 10% of my principal, that limits the amount of positions or stocks that you can own, maybe to very few stocks, if at all, any of those positions that you might be able to own, just based off the fact that a lot of times the stock market can dip 10%, even 20%, and in some cases, what we see in the extremes, 40% in the matter of a couple weeks. So all these things combined together, the objective, the time horizon, the risk tolerance, how actively and passively you want to manage the portfolio, and how much you're going to be contributing and consistently contributing to the portfolio, all combine into what you need to do and what you need to think about, write down, and put on a piece of paper before you start investing your first dollar. And once you kind of have that idea, you can come back and we can talk a little bit more about it. But I think a lot of people want to just start investing and learn as they go. And I think that's highly important. But I think what people tend to do is they generally try to look at somebody else's strategy when that person might be in a completely different boat, completely different time horizon, risk tolerance. They'd want to get their money today. They want to get it in the next year. So they're looking for anything, and they'll invest in things that might go up 20% today and go down 50% tomorrow. And unfortunately, if that's not fitting with your risk tolerance and you don't necessarily know, you're just flying blindly, you might make an inappropriate decision. And then that's what ends up happening with a lot of people. They end up making a very quick decision, trying to follow somebody. It doesn't fit necessarily into their strategy or what they believe is their personal beliefs of what investing should be. And then they get turned off into investing in the stock market. And then they say it's broken. And then you hear all this chatter about, the stock market is a gambling machine and this and that. And all it really does is it takes a simple strategy. And that's not to say that you can't hone this strategy in over time. You could always polish things up. You could say, well, my risk tolerance has changed as I've gotten older. My time horizon is shrinking, so I need to be a little bit more conservative with my money. We're 10 years into this investing journey. I don't necessarily need to get more aggressive with my returns, or, hey, I didn't get aggressive enough in my returns and now I'm kind of stuck to the time limit, or hey, I want to buy a house, so maybe I'm changing the objective to be having two different portfolios, one of which is strictly just holding cash and the other one is continuing to do as I'm doing, but one of them is going to be for buying the house and the other one's going to be for retirement. And I think that those are all extremely valuable things that you need to consider. Debt being another thing. What's your personal debt? That's extremely important into understanding how much you can continually contribute to the portfolio and what you need in order to get to your objectives. So those are all things that you kind of need to sit down and think about in a really quick way to get yourself started on the right foot before you start investing. So be sure, if you're just curious, it's about a 5-10 minute read. If you just want to check this one out, I'll put the link in the description below for you guys. And of course, if you guys are interested in a little bit more about how to read an income statement, so if you want to be more actively investing and looking at balance sheets and doing some fundamental analysis, my buddy Kyle created that course as well. So more than happy to help you guys out. If you have any questions, leave them down in the comment section down below. Really hope this video found you guys well and helps you guys before you dive both feet in without having any sort of plan, or jumping 2 feet out of an airplane before you have a parachute to kind of help you guys land you safely into the investing world. So thanks guys. I'll talk to you guys in the next video. Cheers.